everyone, my name's Anthony and welcome to Metals and Momentum. Now, if you're new here, then I generally will go over a weekly watch list and portions of my newsletter that I send out via Substack. So if you hop over to Substack here, you can see I am Metals and Momentum on Substack. And the most recent newsletter that we're actually going to dive into right now is the silver to oil ratio and how it is reaching all-time highs. Now, I've got the article pulled up here, but one thing that you should know about my newsletter is generally what I do is I will write some sort of investment thought, and we can go through that in a little bit more detail than what I'm about to go through because it's a pretty lengthy article here, but I think it's super important to understand the relationship between oil and silver. And when you look at the ratio chart, you could actually start to see which one is undervalued and which one is overvalued. And I'm also going to show you the MACD indicator of the silver chart here, and you could see that this MACD indicator is at extreme highs. Well, we'll go over that in a little bit, but one of the things that is another portion of my newsletter is the trade and investment recap. Now, if you are a paid subscriber, you get an over-the-shoulder look and you can exactly see what I am doing with my own money, and I will invest real dollars, my own dollars, into whatever the thought of whatever the thought process that I'm actually going to go over in the newsletter. So generally, I will show you how I am going to execute that sort of investment thought. Like, for example, this week we are going over a number of things to do with the silver to oil ratio. So the thing that I'm thinking about is oil and oil stocks really cheap right now? And I think the answer is yes. And I'll go over some of the reasons why I actually think that in a moment. Another portion of my newsletter is something called the value vein, where it's a 1-minute read where you could essentially go through and learn something to do that's going to allow you to become a better investor and trader. Then what we normally go through on the YouTube channel is the weekly watch list, because I essentially throw these charts into the newsletter, try to explain a little bit about them, but I think in video format it's going to work really well, because then I can actually explain a little bit more things going on the chart here. So that's what we normally do on the YouTube channel. This one's going to be a little bit of a lengthier episode because there's only 3 charts that I'm really watching on my weekly watch list. One, it's going to be oil, and I'll go over one of the reasons, the big reason why I think oil is a great buy right now. Then the other chart that's on my weekly watch list is gold. Pretty short little explanation on gold here, but we're also going to talk a lot about silver and this silver to oil ratio. And I think the silver to oil ratio is actually screaming something, and I'm going to show you exactly what it is screaming in this episode. Then, if you are part of the paid tier of my Substack, it's $9 a month if you want to join that. Then you get access to what I call the stoplight stock indicator. Basically, it's just a fairly lengthy list of a number of different stocks that I'm actually looking at, including physical gold and physical silver. And I'm essentially rating it either a proceed with caution, a buy, a hold, a sell, and we'll go over some of the reasons why I go and actually rate that. Like, for example, if something immediately changes from, say, like a buy to a sell, then I'm going to explain that in a little bit more detail and give you some really little bit more in-depth analysis on those individual stocks that I'm actually looking at and following. And then, of course, I do take on other things, like, for example, the S&P 500 is something that we've adopted in the stoplight stock section, because I know some of the subscribers do purchase shares of the S&P 500, and that's where a majority of their net worth is actually laying right now. So we've adopted the S&P 500 in the stoplight stock indicator, and it's just essentially a quick indication on whether or not I think right now it is a buy, sell, proceed with caution kind of thing. And if we look at the chart here, we could actually see that the S&P 500 is actually a screaming sell. And we'll go over that in this episode right now, but I'm getting ahead of myself. I want to first go over the investment thought. Now, normally this is isn't something that I would dive so deeply into, but it very much relates to the weekly watch list that I'm going to talk about. And the investment thought that I'm really focusing on in this bi-weekly newsletter is this silver to oil ratio. I'm a little bit sick right now, so I'm gonna have to take a couple sips of drink here. So bear with me. I was coughing like crazy just a little while ago, so I'm gonna hopefully make it through without a crazy interruption. But the first thing that we have to go over is what is the silver to oil ratio, and it essentially is a measurement tool that you can use. Now, a lot of people use a number of different measurement tools to compare one asset to another. So for example, the gold to home ratio is a really popular one that a lot of people will use. When it costs like 1,000 ounces of gold to buy a house, you might want to consider buying the gold opposed to buying the house. And then recently we've seen housing decline pretty dramatically. And it would have been amazing to buy the gold at like the high, and when that ratio drops down, you could essentially trade the gold for the house or vice versa, whatever the asset that you're actually comparing. So one of the things that's super interesting is the silver to oil ratio. And it's showing you that the silver to oil ratio is at an extreme high. Like for example, we have never been this high on the silver to oil ratio. So let me break this chart down, and I did so just above here. So if silver today is trading at $80 US per ounce, and oil trades for about $57 US per barrel, that means the ratio would be about 1.4. Now, when I pulled this chart, silver was slightly higher than where it is right now. If I were to update this chart at this moment in time, you're going to see a little bit of a pullback, probably closer to 1.2 right now, but still very, very high. We're actually at an all-time high on the silver to oil ratio. And generally, I would like to use this ratio, especially when comparing these two assets, because silver and oil are actually very, very similar. Now, silver is a much smaller market when compared to oil, but both are finite, like real assets. Both are inputs into industrial production. Like for example, when the economy is expanding, then generally oil prices will rise, but also silver prices will rise because it's essentially used in just about everything. And I mean, we couldn't live this technical life without silver, and we couldn't do all the things like, for example, grow much more food. We couldn't drive our cars. We couldn't do all sorts of different things without oil. And that's one of the reasons why when we enter into crisis periods, generally people are looking for safe plays. Like, for example, what's tried and true, what has stood the test of time for long periods of time. And generally, when we enter into a crisis, you're going to start to see a movement from, the very speculative assets to something like the safe haven plays. And generally, actually, oil tends to be one of those safe haven plays until the crisis actually happens. And we can actually go through a situation where I was actually looking at ExxonMobil, and we can actually see that during, I was going back to 2008, and we can actually see what happened in 2008. We can see this play out to a T. So the real crisis started to build up from 2006 to 2008. So from, let's call it January, February, March, April, May, June of 2006, we see oil stocks really bottom out in this little pattern, this, we can call this like a little channel here, right? And let me just pull up the little divider here. So once we actually break out and form that last bottom in 2006, we could see a significant run up in the price of ExxonMobil from peak to trough here. Let's just quickly measure it out. We can see that the peak to trough was 66%, which is that's a pretty significant rise. And what we notice is that ExxonMobil actually formed another channel up right here, somewhere around like here. this is that topping channel. And then when that crisis started to really hit, we see a little bit of volatility at the top here. But once that crisis started to get going, like in the mid 2008 kind of time period where like banks are collapsing, we're realizing that the economy starts to collapse as well, we can see that oil stocks then start to really take a hit. And then of course in October of 2008, that's when, oil stocks essentially bottomed out for that time period, and then started to trade sideways for quite a long period of time. We get a final peak back in 2010, and then it essentially goes back up, and we start to form a new bull trend at that price point. But one of the things that I was looking at is a lot of oil stocks generally play out in the same kind of period, like the same time period where we start to go into a crisis and then we start to move to a safe haven kind of play. Now, if we go to ExxonMobil and just look at the valuations of a lot of the oil stocks right now, we can see that the valuations are very, very low. Like for example, I think the S&P 500 right now, the PE ratio is somewhere around like 30 or something like that, 28, 35. It kind of varies because it's like the index, but at the same time, we're talking a much higher PE ratio than a lot of the other oil stocks that are out there right now. For example, ExxonMobil trading at a price to earnings ratio of 17. That is quite low, and also paying a fairly significant dividend as well. And if we go back to like the recent time period, what we can see is that, remember at the beginning of 2006 to 2008, we saw this long period of consolidation, and then we get that breakout, we get that massive move upward, and we can start to see that this is actually maybe playing out right now. Now, there's two channels that we're trading in right now. One is this larger long-term channel. So for example, we're bouncing around somewhere around here. We reach the top, we come back down, go a little bit lower, but we're still trading within this channel. And then there's this mini other channel that we're kind of trading in and kind of signaling that, we're in a solid uptrend right now. But over the last couple days, what we've actually seen is a breakout of the larger channel that we're actually trading in right here. So this is something that I'm definitely watching, and especially because the valuations of a lot of things are at near all-time highs. Like for example, gold, silver, Bitcoin is fairly close to all-time highs. Just about every other metal is at all-time highs except oil. And I'm wondering right now, is oil stocks and oil maybe that play right before the crisis starts to kind of happen and the overall stock market just starts to decline? And when I was looking at the S&P 500, it's not looking good for the S&P 500. Like we were trading in this wedge pattern. Then we broke out of the wedge pattern. We even retraced, touched the wedge pattern, broke back down, and we're trading sideways in this little consolidation kind of pattern right here. And I think in 2026, we are going to see at some point in time the S&P 500 trail back down and make a retrace to 6,100 or so. I think we could actually maybe even, I don't know. It's going to be hard to say like if we break 6,100 or not in 2026, but I think a retrace back down to somewhere around here is going to be likely. Now, the only thing that kind of makes me hesitant on that, and one of the reasons why I'm thinking I'm so bullish on oil right now, is because the announcement of Donald Trump essentially saying that, the new Federal Reserve chairman, whoever that's going to be, essentially has to agree to lower interest rates and start money printing. And it's quite funny that he's saying this, because he's also saying that the United States is like the greatest economy ever, which doesn't coincide with we need money printing and 0% interest rates. But that's why I'm kind of looking at oil right now and thinking like, holy smokes, that is like the one asset that is very undervalued compared to just about everything else, especially silver. And one of the things that I was looking at of silver is just like that historic behavior and how that ratio actually acts out. So for example, the ratio tends to rise during financial stress, recessions, period of monetary easing. Now, the Federal Reserve in the United States, they just announced that, they are not quantitative tightening anymore, but they're not quantitative easing either, but yet they're also essentially starting to print money. And Donald Trump is pushing for lower interest rates right now. So we're essentially quantitative easing without quantitative easing, which is kind of funny that's what they're saying, right? But the ratio tends to fall during economic expansions. So oil tends to rise during economic expansions. But lately we've been seeing more use cases for silver. So if oil starts to rise and silver stays at about the same price that it's at right now, then that ratio is going to fall back into that norm, right? Like, for example, if oil starts to rise but silver stays the same thing, what's going to end up happening is we start to go back into maybe this type of range, right? And that's where I think a lot of money could potentially be made, is if you're looking at these undervalued assets versus other assets that are at quite extreme highs. And we know silver is at an extreme high because, just look at the price action. Over 2025, we've seen a 140% increase in the price of silver. So the other thing that is like a huge red flag is this MACD indicator. Now, if you go back and look at previous points in time where silver was not necessarily super overbought, but it was overbought a little bit, you can see that the MACD indicator goes like a little bit higher opposed to like the mean here. And then when we start to get that sell-off, you start to see that the sell-off starts to indicate under, like, this would, if this is overbought, this would be like oversold, right? And then we start to get a reversal in that. We start to see a massive run up or not massive, but a fairly significant run up in silver. And then we start to see that MACD come back to being overbought and then underbought again, right? But what we've seen recently, especially in 2025, is we've seen this MACD indicator go almost off the charts. Like, this is like extreme overbought on the MACD indicator. We've seen silver run 140% in 2025. And I'm thinking that this chart says that this is going to pull back for sure. Like, for example, and this would actually be quite normal. Like, for a lot of charts, whenever you break up into all-time highs, like here's the break into all-time high kind of territory, we get a significant run up, but then what ends up happening is we tend to retrace to essentially like the scene of the crime where, the breakout essentially happens, and that acts as key support. So if we get a rise in oil and also a significant pullback in silver, and I'm just going to use oops, that's not the line that I wanted. I wanted an info line. If we get a pullback back to 50, let's call this 54.50 or something like that, then that would be a decline in the price of silver by 23%. I think this would actually be very, very normal, and it would actually be almost really, really healthy for the MACD indicator to come down and actually maybe get a little bit closer to that mean, even if we don't go like to extreme overbought or extreme oversold conditions. Then that pullback would actually mean that, silver could actually consolidate around this key support area. And then that next move silver could be like a significant one, and probably stretched out over like a much longer time period. Like, it would probably take many, many years of sideways, or at least like a year of sideways consolidation, and then we get that upward movement, and it would be much larger than the recent big jump in silver. It would probably look more something closer to like this, and then we could start to maybe reach that $100 price point, and I think that would be a more likely scenario opposed to silver just rocketing to $100 like right now. Unfortunately, that's not what a lot of silver investors want to hear, but I think that is a realistic projection for silver in 2026. And this would actually coincide with this silver to oil ratio coming back into a little bit more of like this general area, just that mean kind of area, like 0.40. And that would make a lot more sense. And especially if we could get oil to rise. And let's check out the price of oil. I'm going to go over this on the weekly watch list as well. And I posted this in the newsletter. But basically, we've been trading in this sideways this wedge pattern. And then a little bit of a sideways channel here. Like we experienced a little bit of pop. This helped form the wedge pattern. And then we start to go down and trade, creating that wedge pattern. But wedge patterns, either they break up or downward. I'm just going to, let me get what do we want? Like a dot, I guess. So it could, oh no, let's use this. So how this wedge pattern is going to play up is it's going to go either one of these two directions. It's going to go up or downward. And when this wedge pattern plays out, if it goes up, what we could expect from oil is we can actually experience a 15% increase in the price of oil. And this would actually bring us right to the point where oil companies actually start to make money again. Like, for example, a lot of these oil companies, they actually require $65 a barrel of oil to actually generate a little bit of a profit. Whereas right now we are at a point where oil companies are actually not generating a profit at $57. So what's going to end up happening is we are probably going to see oil companies announce that they are going to stop production and stop drilling for oil. And that is going to maybe present a short-term little pop in oil. And I think that's going to probably push the oil stocks up about 30, maybe 40%, maybe even 50%, depending on how crazy the mania kind of gets. But that would also coincide with this silver to oil ratio as well. Both of these assets are finite. They're real assets. They're inputs into industrial production. They respond to currency debasement and inflation expectations as well. And that's one of the main concerns for a lot of people right now. One of the reasons why people don't want 0% interest rates and don't want monetary easing right now is because inflation expectations would just go up. And you know, we've got inflation sort of back down to about 3%, nowhere near the 2% target that the Federal Reserve actually wants. But we were like 12% not too long ago. And I think if we start to increase the monetary easing and also lower interest rates, those inflation expectations are going to go up. And that's why I think maybe silver could have a pullback, but not go down to, say, something like $30. I don't think we're actually going to go back to $30 whatsoever on silver, but we're likely going to have a pullback to about 54, somewhere around there. And that's why I'm thinking, like, when I'm looking at where to place money in 2026, I'm looking at this ratio chart and I go, I'm a little bit hesitant on silver, although if I had no silver, then I would probably still buy. But if I had some silver, I'd probably just wait for a little bit of a better opportunity. If I had no silver, I would be thinking like maybe I would start to accumulate now. And then as the price of silver starts to drop lower, then I would still continue to accumulate during that time period and just lower my cost basis. But I wouldn't necessarily be banking on $55 silver again if I had no silver, but that's not necessarily the position that I'm in. I actually bought silver at around 35, 50, and also at like 18 at one point in time as well. So I got in at a good price point here. So I'm pretty solid on my silver holdings, but the historical behavior of this ratio is also kind of interesting. We went over the part, where once we start to enter into that crisis, we see that pop in oil stocks that that resurgence of investors. They want to go to something that's safe and paying maybe dividends as well, but also some notable periods where silver and oil also really performed is during the late 70s to early 1980s. Like one of the peaks in silver was during the 1980s, and that was because the monetary debasement was actually in full force, right? And that's the period that we're actually kind of entering into. Is I think that the next little while is going to be quite inflationary, and that's one of the reasons why I'm looking at undervalued assets and thinking, what is cheap right now? A lot of, gold, it's not that cheap anymore. Silver, not that cheap, although it's probably going to go a lot higher than where it's at right now. It's still not that cheap. We've just broken out to all-time highs, which is a pretty good kind of trend indicator, right? Like it's not like it's super high. Like for example, Bitcoin is at like 100,000 or just under 90,000 or so right now. That's pretty high. Might not want to buy into Bitcoin right now, but there's not a lot of things that are as cheap as a lot of the oil stocks. And one of the things that I was also thinking about is some of the other oil stocks that are especially located within Canada. Like for example, IMO. IMO is a company that has significant operations within Canada. They're available on the New York Stock Exchange and the Toronto Stock Exchange. And what we've seen recently is we've seen these channels kind of form on IMO, and we're actually seeing another channel kind of play out, and actually a pullback back to that 200-day moving average, which is one of the reasons why I sent trade notifications out to my Substack subscribers saying that right around here was a great entry point for IMO. And we actually started to accumulate shares on the way up here, because I think another channel is going to form and we could get a final breakout on IMO. But if we can accumulate most of our shares at the base of a channel, like for example, like if you were to buy back right around here when we tapped or got close to that 200-day moving average, once that channel kind of formed and then once we broke out, you made significant gains. Like for example, from like here to here, like this is a 50% move. That's pretty significant, right? So this is one of the positions that I took with some Substack subscribers right now, and IMO is a position that I recently started to accumulate, and that's because I was looking at the silver to oil ratio, and then just the overall price and value that you're getting with some of these oil stocks. I think it's an area that a lot of people started to are going to want to really look into. So like I said, I wrote a significant article on this the silver to oil ratio. I'm going to leave that in the description down below. This video is already getting quite long, but I want to go over the trade and investment recap. Like I mentioned, just a couple of the stocks. The IMO was definitely one of the stocks that I was recommending to and telling my subscribers that I was actually purchasing with my own money. So I did send trade notifications out on a number of different oil stocks. So if you're reading through the newsletter and you're a paid subscriber, you can click the link here and you're going to see that oil stock buy list, and you can go through and actually make moves if you want to do that based off of the basket of oil stocks that I've actually purchased for myself. So totally up to you. You can go through and read through the information as you wish, but one of the things that we definitely did this week is purchase some of these oil stocks for sure. The other thing that is also really interesting is a part of the newsletter where I call it the value vein. It's going to be a 1-minute read that you can kind of go through and learn something that's going to allow you to become a better investor and trader. So the whole point of the value vein is talking about when questions opposed to if questions. So an if question is something like, if NVIDIA becomes like the biggest company in the entire world and continues to do fantastic for the next 20 years, then I'm going to be rich over the next 20 years. Like that's an if question, right? Whereas like a when question is like, Right now, oil is trading lower than the actual cost to drill and bring that out of the ground, right? Like, for example, oil companies, they need to make $65. They need to have oil be at $65 a barrel to actually generate a profit. And oil right now is trading at $57. So if the price of oil rises, and it's not really an if, it's actually more of like a when the price of oil matches the price of the cost that it actually costs the oil companies to actually generate a profit, then these are the types of investments that I would prefer to make. I don't want to be gambling on the next Nvidia or the next Amazon or the next Tesla or whatever it is. I would rather look at commodities and assets and understand that there are certain things that just have to happen at some point in time. Like, for example, if you want your car to start when you hit that start button because there's oil in your car, then you're going to need to pay the oil companies a certain dollar value, or they're going to stop drilling oil, and eventually that price per barrel is going to come up. And that's a when question opposed to an if question. And that's what I'm looking at oil right now and looking at WTI and thinking to myself, like, yeah, like we could not be at the bottom right now. Like we could go 50, we could go $40 a barrel, but that just solidifies the fact that oil companies are definitely going to stop drilling for oil at a certain point in time, and that is going to raise the price of oil back up again. And if we're going into a period, we just read through the article where we saw that during periods of expansion, like for example, when we're lowering interest rates and we're printing a bunch of money, generally oil does very, very well. And that's why I'm thinking that all the stars are kind of aligning for oil to experience a fairly significant pop. I just put on the WTI chart like a minimum pop of 15%, but we could definitely go back to like $80 a barrel oil, especially if like a war breaks out or something like that. And it's kind of happening in Venezuela right now. So if oil goes, experiences a little bit of a pop right here, I think the oil stocks are also going to experience like double the returns of WTI. And, you know, I just charted out like the little channel that we've been trading in for a little bit of time here. And then that wedge pattern, this from top to bottom here is just a 15% move. If we go back to $80 a barrel, that's like a 40% move, and oil stocks could go up like about 80, maybe even 100%. And that's a pretty interesting risk reward kind of thing. So that's the value vein right there. And we're getting into the weekly watch list. I've kind of blended that into this section right here. But another chart that I'm definitely paying attention to is the gold chart for sure. Gold has had just an amazing year. I think it's up 70% in 2025, which is pretty unbelievable. Like the rise in gold, like starting at $2,600, and today we are trading at $4,331. That is a pretty incredible move on the price of gold. And I'm thinking that we could experience another run up to maybe $5,000, especially if we break out of this pattern that we're forming on the chart. And we're actually going to see whether or not gold is going to trade up or trade down for 2026 very, very soon, because we've formed this. This is actually a bull flag, which is a good sign. So there's a higher likelihood that we're going to trade higher than lower, but we're gonna determine what is going to happen in the next couple days here, because that's why I'm watching this chart so closely. Is if we experience another little bump, we could see this bull flag actually play out. We've seen the upward movement. This is this long pull, and then we've seen some consolidation, some sideways action. Not really. We've seen a little bit of a dip, but we're essentially flat since October, the end of October there. And this next move is going to be either up or down here. And we're going to see it either break this little sideways consolidation pattern and potentially make another retracement down to 3,900 or so. Or we're going to break upward. And I think if this breaks upward, that's going to take us to about 5,100. It'll be somewhere close to right here. And if we draw this out on the chart here, our options are down here or up. And this would essentially take us to about 5,100, somewhere like this. And that is the chart on gold right now. And these are the things that I'm actually watching for. If we start to break upward, what I think I'm going to start to do is actually accumulate some of the gold miners, because if we start to break up and start to push over 5,000, we're going to experience some fireworks in the gold miners, because people are going to get very, very excited once we start to get close to $5,000. And if we see the breakout happen here, we can start to accumulate those gold miners. And by the time we reach $5,000, those gold miners are going to fly for sure. So it's something that I'm watching, and I'm thinking that I already have a list of gold miners that I'm looking to accumulate, but once we want to wait for the price action to play out in physical metal before we move to those gold miners for sure. The other chart that I'm watching, I'm looking for that pullback on silver. I want to see a retracement back to $54. By that time, the MACD indicator on silver is going to be extremely low. It's going to probably get back to near zero, if not be a little bit undersold by that time as well. And by that time, I think this would be a really, really smart area to start to accumulate for the long term. And that's what physical metals is for me. It's a long-term accumulation. And I'm going to store that outside of my own home. So that way, you know, I'm playing it safe there as well. So I think the price point that to look out for is about $54.50, somewhere around there. I would even start to accumulate around $60 because, you know, it might not actually fully touch $54.50. If I had no physical silver right now, I would probably just start buying and disregard the price. And that's kind of the weekly watch list there. There wasn't a ton of things in the weekly watch list, but I think there's some good value there. The main thing that I really wanted to highlight here is oil stocks for sure. And now for paid subscribers, you can go into the Stoplight Stock section of the newsletter, and you're going to actually see a rating system that I update on a bi-weekly basis. Now, I generally will think in longer term perspective with the Stoplight Stock indicators, but I'm going to use the same technical analysis that we just dove into, but use it on a number of different charts on a bi-weekly basis. And I'm going to rate that stock or asset a buy, a proceed with caution, a hold, a sell. And then give you some more information about what I've actually changed. Like, for example, if something goes from, say, like a hold to a buy, I'm going to write a little bit more details as to what's going on with that company, what's going on with the stock, what's going on with the technical analysis. We're blending technical analysis with a little bit of a longer term perspective in the Stoplight Stock indicator kind of section. Generally, what I like to do is for 2025, I think it's so important to become a little bit more nimble in the way that you're actually investing. Recently, I don't think anything really is a long-term buy or a hold, with the exception of physical gold and physical silver. That to me is a long-term hold. I'm not going to trade around that too much, but there's a lot of things that are going on, especially with the S&P 500. If I just quickly hop over to TradingView and pull up the S&P 500 before I leave you here, this is a incredibly bearish chart right here. One of the things that I was thinking about too is we should have risen and made all-time highs during the December Santa Claus rally, but we didn't. And if the month of January ends in the red, then I think in 2026, we are going to experience probably a significant crash and pullback in the S&P 500. I think minimum is going to be 20%. But stocks are so overvalued right now that it could be a lot more than that. I am not 100% sure. We're going to watch the charts and make sure that we're navigating it using technical analysis and being much more nimble than previous years in the past where, you'd want to maybe hold things for 2 to 5 years. I don't think that game is going to play out for a lot of investors anymore. And if the S&P 500 trades sideways for all of 2026 while inflation starts to pick up, like for example, we're at 3% in the US right now. If they start to lower interest rates and print a bunch of money, inflation is going to go a lot higher than 3%. And if the S&P 500 doesn't at least, give you 4% for 2026, then, you're in trouble. You're underwater. You're actually losing money, even if the S&P 500 doesn't do anything on the year. Like if it just trades sideways for a year, then you're in trouble. And when you look at the evaluations that are going on in the S&P 500, that is a very, very bad signal for a lot of the major stocks in the United States right now. They are way too high. We have things like NVIDIA, Palantir, like, oh my gosh, like the Palantir, the PE ratio on Palantir was like something like 400. That is crazy. A lot of these stocks are just way too expensive. And that's one of the reasons why I think adding technical analysis into your bag of tricks when it comes to investing is something that is going to become much more important for the future. And if you want somebody to help you with that, consider subscribing to my Substack. We have a free tier. We also have the paid tier, $9 a month, and it's going to help you a little bit more in more detail. Like I said, with trade notifications, I'm going to show you exactly what I do with my money, and then you get access to the stoplight stock indicator, and I will add stocks into that section if you reach out and ask me to do so. For example, the S&P 500, I never buy shares of the S&P 500, but some of my subscribers do. So I've added that to the stoplight stock indicator, and we've been watching the S&P 500 for all of 2025. So if you have recommendations, let me know, and I'll double check that you are a paid subscriber to my Substack, and that's where I'm going to leave it. Thanks so much for watching. I know this is a long one, but it's the first one of 2026, January 4th, today. And it's going to be interesting the next couple of weeks. So stay tuned on YouTube and subscribe to Metals and Momentum on Substack. My name's Anthony, and we'll see you in the next one.